Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, November 3rd, 5:20 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a correction, still trending under the long-term 200-day moving average. The short-term uptrend that we entered a couple of weeks ago is on life support after a big negative reversal yesterday on some very hawkish comments from Fed Chief Jerome Powell. You can see over here on the trend gauge, leadership still holding up pretty well. We're showing bullish, albeit with a red sub arrow, as only 2 of the 21 over 21 from last week have fallen beneath the 21-day exponential moving average, which is pretty impressive from a leadership standpoint, considering what's going on with the indices. We did downgrade the short-term 21-day exponential moving average trend arrow today from bullish to neutral, as we've had 2 closes on the S&P 500 below the 21, and the NASDAQ 100 never was able to regain the 21. The other 5 indexes relative to their medium-term 50-day moving average, we still got the Dow firmly above, small and mid caps hanging on by a thread, and the NASDAQ 100 and the S&P below their 50-day moving average. Long-term, with a failure of the Dow at the 200-day yesterday, we want to see how it closes for the week, but looking like we'll be back to red, well, sticking with red, but the sub-green arrow will go away as basically we're looking at the Dow having failed at the 200-day moving average yesterday. So what happened today? Tech continues to just be an absolute drag. It drugged the S&P 500 and the NASDAQ 100 lower, and they underperformed today. And really, if you look under the hood, it's all because of the XLC communications and XLK tech sub-sectors beneath the S&P 500. On the day, G6 actually had a decent day, only down 0.1%. S&P 500 down 1.06, NASDAQ 100 down 1.95, Dow down 0.5. It continues to be the outperforming big cap index. Mid caps down 0.23, Russell 2000 small caps down 0.5, Global Diversified 60/40 stock and bond down 0.63. In-house GROTECTION down just a bit, down 0.04%, as we are effectively neutral now. We've got an inverse ETF and 3 small longs, so basically we're about the equivalent of flat on an adjusted beta basis. Before we dive into the charts, I'm going to get into why we do what we do here at Revere. So at Revere, we are a fee-based only, conflict of interest free fiduciary. We're fully transparent. We're registered, a registered investment advisor, registered with the SEC. Our flagship portfolio is called GROTECTION, which means we grow assets in uptrends and protect assets in downtrends. We manage individual client portfolios using trend following rules. In an ideal market, you saw in the trend gauge prior how we break the market down into 3 time frames and into what leaders are doing. In an ideal market for the growth part of GROTECTION, we're trending above all 3 of the moving averages. At this point, we're basically fully invested in the market. We shift to neutral if we start rolling over and our stops take us out. Take a little bit more off the table if the trends of the short term and medium term start to roll over, and then we go into protection mode if we break below the black line, the 200-day moving average, and that's because of this chart right here. All of these severe bear markets take place below the 200-day moving average, and you just can't afford to lose half of your nest egg if you approach or are greeted with an unfortunate sequence of returns scenario as you approach retirement. So that's why under the 200-day moving average, that's where all those bear markets occur. We are maximum at defensiveness, and we then wait for some short-term signals to re-enter using the moving averages and the presence of leadership. And if you're interested in this approach, common sense approach, give us a call, 855-REAL-WEALTH or 855-732-5932, or you can email me, Don@revereasset.com, or my partner, Danny Stewart, dan@revereasset.com. So going into the charts, you can see the big negative reversal yesterday. Let's bring up a 5-minute chart here, and you can see really Jerome Powell. First, the statement came out, perceived as bullish, then he started talking, flipped to hawkish. The market sold off. We had a gap down today. No real further progress down, so today's lows are key, right around that 3,700 area. But really what we're seeing in particular, let me bring up the NASDAQ 100, is the severe underperformance of, as I mentioned, XLC and XLK. You can see the big gap down and really closing near the lows of the day on the NASDAQ 100, as this continues to be the weakest of the indexes, and those two sub-indexes under the S&P 500. Communication services made a lower low. Meta is in here, Google is in here. And then you've got XLK, where the rest of the big tech numbers are. Didn't quite make a lower low yet, but it's the second weakest of the major indexes. Let's shift to the Dow Jones Industrial Average, which is the strongest because it's nowhere near as tech heavy. You can see the break of the 200-day moving average closed closer to the top of its range today than the lower part and above the 21-day moving average. Here's MDY, the mid caps. Continuing to show relative strength over the last 2 weeks, undercut but reclaimed the 50-day moving average and the 21, and IWM. Small cap, same situation, undercut, but basically closed right on the intersection of the 50-day moving average and 21. So those three indexes, mid cap, small caps, and the Dow Jones Industrial Average, are where the money is flowing into, and it's flowing out of tech and therefore out of the NASDAQ 100. And because of the heavy weighting in the S&P 500, that's underperforming also. So let's get to the tail of the tape. First, let's get to a couple of subsectors that we want to take a look at. First of all, let's go to the VIX, which on a down day today was down, ironically, or surprisingly, I should say, not ironically, still trending below all of the three key moving averages. But note how oversold we're getting on the stochastic. And yeah, we can stay there for a couple of weeks, but you can see the sharp rallies back up higher off of that, and those coincide with sharp sell-offs on the market. So that's kind of keep an eye out for the 2x4 relative to that. How about gold? How'd that do today? The dollar was down. Not a good day for the dollar, but despite that, gold rallied a little bit to close at least at the top of its range after coming close to making new lows. Let's take a look at the dollar using UUP. Again, strong dollar, bad for stocks. That's been a consistent relationship with stocks all throughout this bear market. You can see all the way back here how low the dollar was in January, where we started, about 25.50. We're up here to 31. Doesn't sound like a lot, but that's a big gain for a currency. Let's go to the 10-year 0TNX. Rates up have been also bad for the market. We closed at the bottom of the range today despite gapping up. That's on the 10-year, and on the 30-year 0TYX, same situation, gap up, pulled back, closed at the low of the range, trending for months above this 21-day exponential moving average. And as long as that relationship remains intact, that's a headwind for stocks. Let's go to Bitcoin BITO. Look at a 60-minute chart on that to see that 1250, we're right at that 1250. So really we're between 13 and 1250. Let's call it 1240 now after this last pullback. And this is still looking kind of like a bull flag or a flag. It's a bull flag because a flag at the top of a flagpole is considered a bull flag, but break below that 1240 level will break that down as I reset my alert here. So let's go to the tail of the tape. Now you can see we changed the technicals, all negative now, with the indexes in the G6, with the daily stochastic being negative, the NASI and the RSI hooking down. That's the McClellan Summation Index. Dollar above the 21, and the 10 and the 30-year above the 21 is a negative. Bull case on on life support, hasn't broken below the 1021 low of the follow-through day on the S&P 500 yet. But for all intents and purposes, we're really not looking to put much more exposure on. But again, we're not locked into it. Tomorrow is a key jobs report. That's what's listed under the news, and a very weak jobs report should spark a rally. I say should, there are no guarantees, but bad news is good news in this market. Anything that can lead to the Fed stopping their crusade against inflation, which includes consistently rising interest rates, which just is a drag on the economy. So some notes, we went from day 2 down to day 3 down. It's actually day 4. Day 1 was really a consolidation day. Leaders and the Dow, mid caps and small, all showed relative strength. In fact, on my leaders list was like 75 to 80% green today. It looked, if you looked at the indexes, you'd have thought they'd have been up, and that's really because of big cap tech dragging down the S&P and the NASDAQ 100. Expectations have flipped to negative. That's what we saw in the indexes today. We are hanging out with the close at 3720. We're hanging right at this support area, 3715 to 3730. We touched 3700 today, so I'll expand that a little bit. We're basically at support here. NASDAQ 100, top of the range held also. Tight range, tight chop most of the day after that initial gap down. What was up today? Oils, solar, coal. Boeing had a second straight up day. They are really talking about an improved cash flow position for themselves going forward in 2023. Let's take a look at that as a key chart. I've got an alert set for that. Should it get back above the 200-day moving average, I really want to get interested in it if it does. But you can see these two big up days after its earnings shakeout. If I've studied a lot of earnings, if the low of the earnings day holds and you make a higher high above the high of that earnings day, that's an inflection point, a bullish inflection point, and then you look for a decent entry. I understand there's a lot of overhead support here, but you got to understand large cap managers need to put their money somewhere. They're going to put it in the least risky spot. Right now, the least risky spot is anything but tech. You can see 2023, Boeing is saying they're going to get back to a positive earnings situation, earning $4 a share after in 2020 losing 23, then 9, then 6. That's music to the ears of anybody that wants to get their money back in Boeing. And this reaction to earnings and then the talk of the cash flow over the last couple of days has really lit a fire into that. And that is why the industrials were up today, why the aerospace defense sector was up today. Basic materials also up and utilities up. Silver was up on the downside. Bonds, XLC and XLK, software, and gold stocks. So what were we focused on today? Our current holdings coming in, HLIT, PI, staying in LNG, UPRO, and SPXS. UPRO was our long. When we broke back below that 3730 level where we bought that, we got stopped out on it. So we ended up selling our UPRO, also sold our HLIT as we couldn't get back above the 21-day exponential moving average on that. Let's take a look here. Several times we touched this 21 and failed every time. We stopped out for a very small gain on that. I don't have to show you the S&P 500. That's UPRO. So now we're still holding 5% short on SPXS. We'll hold that at least until we're continue to trend below the 21-day exponential moving average. Let's take a look at that on the S&P 500. It went from up to rolling over, and now it's trending lower. We're pretty close to it. Any move up into that, my expectation is that it would fail after the news today. If you look at yesterday, every inflection point that we've had on the negative side has led to further downside. The exception being after 6, 7 down days, we had a rubber band snap after the last bad CPI report. So it could be that, as I said before, a good or a bad jobs report tomorrow would be considered bullish for the market, and we may kick off a rally. Then the question is that rally being used to sell into, which is what the case has been for all big cap tech all throughout this most recent leg down. So we also added 5% T-bills, yielding about 3.5%. So we've got 20% of the portfolio in T-bills now. Basically, with that yield, a client is getting a risk-free return that can pay half or more of their management fee. So, and then just leave us to manage the rest of the portfolio. What a deal when you think about it. Considering how we provide downside protection. Yes, we're down on the year, but down half of what the S&P 500 is. And what are we still holding? The other things that I was focused on is PI, Impinj, closed flat today, still consolidating nicely, holding up very well after its big earnings gap up on big volume. And then STNG, Scorpio Tankers, had another making anything that's making a new high in this market. You got to pay attention to it. Consolidation day on a terrible down day yesterday, up on higher volume today, tried to break out, pulled back right to the top of the range, but you can see the big up volume and then the one down volume day yesterday. And then LNG reported earnings. They reported a big loss, but it had to do with derivatives, having to mark them to market going forward. You can see the big loss, but that can be made up in future quarters. The reaction was initially a gap down, a bounce off the 21-day exponential moving average, and then pulled back from the pivot. We're looking to add to this. Oil, anything energy can be sectors that can be counter trend to what the overall indexes are doing. Oil absolutely being the least correlated to the overall S&P 500. So still in LNG, still in STNG, still in PI, and the 5% short via SPXS. So our effective beta is basically flat, 0.01. Bottom line, downside follow through, but it's because of, you can really point to XLC and XLK dragging down the Qs and the S&P 500. We really want to hold this next support area down, 3,700 to 3,730, which we touched today and closed in that range. The next level down is 3,736 to 3,647, which were lows from June and then lows again from September. So that is the story for today. I got a bunch of stocks down significantly, former leaders that were broken, just getting hammered after hours. Let's go through them quickly. Expedia. I'm going to have to expand this a little bit to be able to get the quote. And Expedia was down 10%, now up 2%. How about that? Maybe let's see what the rest of them have done, though, as Expedia is not a tech stock. Let's go to the software stocks. Team, Atlassian Corporation, down 22%. Twilio, infrastructure software, that is down 17%. PayPal, man, PayPal, down 7%. Net, the backbone of the internet, is how I've heard it described, down 12%, and SRTS, which is was a pretty good looking medical stock, down 29%. Some possible winners for tomorrow. Starbucks was going between positive and negative. Its chart has really been shaping up. It's up 2% today. PODD, this is an insulin company, up 10%. And that's where we're going to end it. So as always, love your feedback. Don at revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. So taking a look at the jobs report tomorrow and the reaction to it will be key. Remember, it's not how much you make in the market, it's how much of that you can keep. We're staring at another possible leg lower after the negative reaction to Jerome Powell's hawkishness yesterday. And we don't make predictions, we follow the trend. The trend decidedly has changed over the last 2 days. So wrapping up Thursday, November 3rd, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.